Hello, welcome. My name is Eugene. I am a lecturer in Kenya. I teach professional courses such as SCCA and CPA. My videos cover various topics found in these professional courses. The main subjects covered are management accounting, performance management, and quantitative analysis. I welcome everyone interested in learning something. Sit back, relax, and let's begin. Hello, welcome back to my channel. In this video, I will take you through marginal costing and absorption costing. Marginal costing. Introduction. Marginal costing is a management accounting technique that considers only variable costs when determining the cost of products or services. Fixed overheads are treated as period costs and are written off in full against the contribution in the period they are incurred. Variable costs are costs that change in direct proportion to the activity level. For example, raw materials costs. Fixed overheads are costs that remain constant regardless of changes in the activity level. For example, rent. Arguments for the use of marginal costing. 1. Relevant for short-term decisions. Marginal costing emphasizes contribution, which is crucial for evaluating the profitability of additional sales or special orders without distorting figures with fixed cost allocations. 2. Focus on cost behavior. Marginal costing helps managers to understand how costs behave with changes in the activity level, which aids in break-even analysis and forecasting. 3. Marginal costing is easy to understand and use since it focuses only on variable costs, avoiding complex allocations of fixed costs. 4. Better performance evaluation. Marginal costing treats fixed costs as period expenses, hence it prevents profit manipulation through inventory buildup, promoting a more transparent view of operational efficiency. 5. Adaptability in competitive markets. Marginal costing is useful for pricing strategies in price-sensitive industries as it highlights the minimum price needed to cover variable costs and contribute to fixed costs. Advantages of marginal costing. 1. Simplifies cost control. Marginal costing distinguishes clearly between variable and fixed costs, allowing managers to focus on controlling variable costs, which are directly linked to production activity. 2. Aids in decision-making. Marginal costing provides insights into contribution margins, which helps with decisions like pricing, product mix, make or buy decisions, and break-even analysis. 3. Avoids over or under absorption. Unlike absorption costing, marginal costing eliminates issues related to arbitrary allocation of fixed overheads, leading to a more accurate short-term profitability assessment. 4. Facilitates profit planning. Contribution analysis helps in understanding how changes in sales volume affects profits. 5. Useful for budgeting and forecasting. Marginal costing aligns well with flexible budgeting as costs are categorized by their behavior. Disadvantages of marginal costing. 1. Risk of underpricing. By excluding the fixed costs from inventory valuation, marginal costing may understate product costs, which can be misleading for long-term pricing or profitability decisions. 2. Not suitable for external reporting. Generally, marginal costing is not accepted under GAAP or IFRS for financial statements, as it does not comply with the requirements to include all production costs in the inventory. 3. Challenges in cost classification. Separating variable and fixed costs accurately can be difficult, especially for semi-variable costs. 4. Potential for short-term focus. Marginal costing may encourage decisions that overlook the long-term impact of fixed costs, leading to suboptimal strategies. 5. Inventory valuation issues. Inventory is valued at variable cost only, which may not reflect the full economic value. Income statement format under marginal costing. In the income statement under marginal costing, first we'll calculate the contribution by deducting all the variable costs from the sales revenue. We'll deduct all variable costs, whether production or non-production variable costs. Once we get the contribution, we deduct all the fixed costs to get the net profit. Again, we'll have the fixed production costs and fixed non-production costs. Absorption costing. Introduction. Absorption costing or full costing is a management accounting method that captures all the costs, variable and fixed, associated with producing a particular product. All production costs are absorbed by the units produced. Arguments for the use of absorption costing. 1. Absorption costing complies with GAAP and IFRS requirements, hence it is required for external financial reporting. 2. More realistic product costing. By including fixed production overheads, absorption costing provides a more complete picture of the total cost required to produce a unit. 3. Absorption costing is useful for long-term decision-making, such as setting long-term selling prices that ensures all costs are covered. 4. Accurate inventory valuation. Absorption costing ensures that the inventory includes a share of the fixed production overheads, preventing the understatement of inventory value. 5. Stabilizes profit fluctuations. Absorption costing smooths out profit fluctuations that occur when production levels remain constant but sales fluctuate, which is particularly useful for seasonal businesses. Advantages of absorption costing. 1. Absorption costing complies with GAAP and IFRS requirements, hence it is required for external financial reporting. 2. Absorption costing provides a more complete picture of product costs. 3. Absorption costing is useful for long-term pricing decisions and profitability analysis since it accounts for all the production costs. 4. Accurate inventory valuation. Absorption costing ensures that the inventory includes a share of the fixed production costs, preventing the understatement of inventory value. Disadvantages of absorption costing. 1. Absorption costing can be more complex than other costing methods, especially when allocating fixed overheads to multiple products. 2. Potential for misleading profit. If production exceeds sales, profits can appear inflated due to unsold inventory carrying fixed costs. 3. Absorption costing may not provide the best insights for short-term decision-making as it does not separate fixed and variable costs. 4. Absorption costing distributes fixed costs using potentially arbitrary allocations which may misrepresent actual product costs. Income statement format under absorption costing. In the income statement under absorption costing, first we'll calculate the gross profit by subtracting all production costs from the sales revenue. That means we'll subtract both variable and fixed production costs to get the gross profit. Once we have the gross profit, we subtract all the non-production costs to get the net profit. That means you subtract variable and fixed non-production costs from the gross profit to get the net profit. Differences between marginal costing and absorption costing. In absorption costing, both fixed and variable costs are included in product costs, while in marginal costing, only variable costs are included in product costs. In absorption costing, inventory is valued at full production cost, while in marginal costing, inventory is valued at variable production cost only. In absorption costing, profits can vary with inventory levels, while in marginal costing, the profit depends on the actual sales volume. Absorption costing is better for external reporting, while marginal costing is ideal for internal decision making. In absorption costing, fixed costs are included in product costs, while in marginal costing, fixed costs are treated as period costs. Reconciliation statement. A reconciliation statement is prepared to explain the difference in the profit figures reported under marginal costing and absorption costing. Since the two methods treat fixed production overheads differently, the profit reported can vary depending on changes in inventory levels. The table below shows the format for the reconciliation statement. The overhead absorption rate per unit equals to budgeted fixed production overheads divided by budgeted activity level. To calculate the fixed overheads absorbed in inventory, we take the OAR per unit times inventory units. The absorption cost in profit and marginal cost in profit can be reconciled using the difference in profits. To get the difference in profits, we take the change in inventory units times the OAR per unit. To determine which of the profits will be higher, we compare the production units and sales units. If the production units and sales units are equal, then the absorption cost in profit and marginal cost in profit will be equal. If production units are less than sales units, then absorption cost in profit will be less than marginal cost in profit. If production units are greater than sales units, then absorption cost in profit will be greater than marginal cost in profit. Example. The following information has been provided about a company. In the table, we are given the selling price per unit, direct materials cost per unit, direct wages per unit, variable production overheads per unit, variable selling cost per unit, budgeted fixed production overheads, budgeted production units, actual production units, actual sales units, opening inventory units, actual fixed production overheads, and actual fixed selling costs. Required: A. Calculate the profit or loss under marginal costing. B. Calculate the profit or loss under absorption costing. C. Reconcile the marginal costing and absorption costing profits. Answer for example. In Part A, we're using marginal costing principles. This means that inventories will be valued at the variable production cost. To calculate the variable production cost per unit, also referred to as the marginal cost, we'll sum up the direct material cost per unit, direct wages per unit, and variable production overheads per unit. In that case, we'll add $4, $5, and $2, which gives us $11. We also need to check if there are any closing inventory units. To do that, we'll use the formula production units equals to sales units minus opening inventory units plus closing inventory units. We use the actual production units, 13,000, actual sales units, 11,000, and the opening inventory units, 1,000. Using those values, we find that the closing inventory units is 3,000. We can now prepare the income statement using marginal costing principles. We start by computing the sales revenue, which is the selling price per unit, $19, times the actual sales units, 11,000. Next, we calculate the variable cost of sales. Variable cost of sales will be the opening inventory value plus variable production costs less closing inventory value. The value for the opening inventory will be the variable production cost per unit, $11, times 1,000 units. Then for the variable production cost, we have the variable production cost per unit, $11, times the actual production units, 13,000. Then the value for the closing inventory, we have the variable production cost per unit, $11, times 3,000 units. With that, we have variable cost of sales is $121,000. We also get the variable selling costs. The variable selling cost per unit is $0.2. We multiply with the actual sales units, 11,000. That gives us the variable selling cost is $2,200. Now we can get the contribution by subtracting the variable cost of sales, $121,000, and the variable selling cost, $2,200, from the sales revenue. Giving us contribution is $85,800. Next, we subtract all the fixed costs. We have the actual fixed production overheads, $8,900, and the actual fixed selling costs, $3,000. Total fixed cost is $11,900, which is subtract from the contribution, giving us a net profit of $73,900. In Part B, we're using absorption costing principles. Therefore, we need to calculate the full production cost per unit to value the inventories. To get the full production cost per unit, we'll add the variable production cost per unit and the fixed overhead cost per unit. The fixed overhead cost per unit is the overhead absorption rate per unit. To get the overhead absorption rate per unit, we'll take the budgeted fixed production overheads divided by the budgeted activity level. The budgeted activity level is the budgeted production units. In that case, we'll take $7,000 divided by 10,000 units. Therefore, the OAR is $0.7 per unit. In Part A, we got the total variable production cost per unit is $11. Therefore, the full production cost per unit is $11 plus $0.7, giving us $11.7. We also established that the closing inventory is 3,000 units. To calculate the fixed overheads absorbed, we'll multiply the overhead absorption rate per unit and the actual activity level. The actual activity level is the actual production units. In this case, we'll multiply $0.7 and 13,000 units, giving us $9,100. The fixed production overheads absorbed is $9,100, which is greater than the actual fixed production overheads, $8,900. Therefore, we have an over-absorption of fixed overheads. We can now prepare the income statement using absorption costing principles. First, we calculate the sales revenue. We take the selling price per unit, $19, times the actual sales units, 11,000. Next, we calculate the cost of sales. First, we get the value for the opening inventory, which will be the full production cost per unit, $11.7 times 1,000 units. Next, we calculate the variable production costs. We'll take the variable production cost per unit, $11, times actual production units, 13,000. Next, we calculate the fixed production overheads absorbed. We'll take the overhead absorption rate per unit, $0.7, times actual production units, 13,000. Next, we work out the value for the closing inventory. We take the full production cost per unit, $11.7 times 3,000 units. We add the value for the opening inventory, variable production costs, fixed overheads absorbed, then we subtract the value for the closing inventory. That gives us $128,700. Then you need to adjust for the over absorption of fixed overheads. In that case, we'll get the difference between the fixed overheads absorbed, $9,100, and the actual fixed overheads, $8,900. That gives us $200. The cost of sales value will be $128,500 after deducting the value for the over absorption. We subtract the cost of sales from the sales revenue, which gives us a gross profit of $80,500. Then we subtract the selling costs. The variable selling cost is $0.2 per unit times actual sales units, 11,000. Then the fixed selling cost is $3,000. Total selling cost is $5,200, which we subtract from the gross profit to get the net profit. The net profit is $75,300. In Part C, we'll prepare the reconciliation statement to reconcile the marginal costing and absorption costing profits. In the format in the table, we'll start with the absorption costing profit, which is $75,300. Then we add the fixed overheads absorbed in the opening inventory. We'll take the OAR per unit, 0.7, times the opening inventory units, 1,000. Then we'll subtract the fixed overheads absorbed in closing inventory. We'll take the OAR per unit, 0.7, times the number of units for closing inventory, 3,000. With that, we'll get that the marginal cost in profit is $73,900, which is the same profit that we computed in Part A. Alternatively, we can do the reconciliation using the difference in profits approach. First, we need to establish which profit will be higher. To do this, we compare the actual production units, 13,000, and the actual sales units, 11,000. The actual production units is greater than the actual sales units. Therefore, absorption costing profit will be greater than marginal costing profit. The difference in profits will be change in inventory units times the OAR per unit. To get the change in inventory units, we get the difference between the closing inventory units and opening inventory units. In this case, we take 3,000 minus 1,000, which is 2,000. In our reconciliation statement, we have the absorption cost in profit, 75,300. Since we've established that the absorption cost in profit will be higher, we'll subtract the difference in profits to get the marginal cost in profit. The difference in profits will be 2,000 times 0.7, which is the OER per unit. When we subtract, we get the marginal cost in profit is $73,900. Thank you for watching up to this point. I hope you enjoyed the video and learned a lot. Please support the channel by subscribing. Remember to like and comment. See you in the next video. Goodbye.